A wonderful good morning, ladies and gentlemen, and welcome to NAGA and Markets for Breakfast. My name is Alex Duidari, and today it is December the 3rd. It is a Tuesday, and the week did not start all too well for markets so far. There's a number of development that I want to go through with you that have the possibility to really impact markets in a way that didn't take place over the recent amount of time, really, if you ask me. Now, first of all, what we see here, S&P 500, always, I like to gain a little bit of a overview by looking at what are the biggest markets actually doing, and we can see that the S&P yesterday dropped quite significantly. So at least it's one of the bigger drops in the recent history. Okay, but in the bigger picture, what you can see, it's still like not too much, but it is like sizable. And the question is like, okay, what's the reason? What is going on? And what should we expect going further from here? Now, not compared, but in addition to that U.S. stock market decline, we've also seen the U.S. dollar actually also take a hit to the downside. Let me just wait for this page to load here, hopefully. It's taking some time. Here we go. Cyber Monday sale. No, thank you. Here we can see the dollar index dropped quite significantly yesterday as well, showing us that the dollar has lost probably across most other of its currency peers. And we want to have a look at that and try to understand what was actually going on here. So, what we can see is just a quick glance at the table. The pound is up a little bit, even though it was down yesterday. The Kiwi is the big outperformer, and the Australian dollar both are benefiting from the present situation. And also, the euro has gained quite well against the dollar yesterday. And so, what was the reason for that to happen? Well, first of all, we opened the week with very good data out of China, as you remember probably, since we talked about it yesterday. And then we also talked about like how we need to pay attention to data out of Europe, right? And then also to data out of the US. And that's exactly turned out to be that winning strategy for the day yesterday. So because what we had is that the PMIs out of Europe came in positive. Okay, some are still quite below the 50, but all of them or most of them were still like gaining to the upside. So there is a little bit of a recovery trend that is quite visible in Europe to take place here. Secondly, we saw the data, for example, manufacturing PMI out of Canada was hit quite heavily, and manufacturing PMI out of the US came in a little bit better, but that's the one people pay less attention to. People pay attention to this PMI here, or you can see that the rest of the PMI data out of the US came in negative. And in fact, we can also see that there is a trend of the PMIs in the US to continue to be negative, right? I mean, this is all a negative trend from starting from, okay, let us show some more. Okay, like the last better number we had in February. Almost a year ago, and that is a clear sign that the U.S. economy has issues in terms of it's not as bulletproof as Donald Trump likes to show it. And then that is putting China and the US, regarding that phase one deal, in a different situation than we thought was happening before. Because what we were thinking just up to recently was that the U.S. economy is so strong that Donald Trump is leveraging off of it, trying to crush China down because China's economy was hurting, and now we can see that the Chinese economy is actually rebounding while the U.S. economy is starting to show signs of weakness. And Now, if we compare all of that with the state of the negotiation, or let's have a look at this chart first here. This is a chart with the S&P year on year versus the ISM year on year. It's from Bloomberg. And, we can see that the ISM, which is like this blue grayish color, very much correlates with the S&P. Now, what we can see is that the ISM, as of recently, has been dropping, while the S&P has been going up and up and up and up. So the question is this black line going to meet with this blue line? Well, sooner or later it will, for sure. The question is just like how much. And you can see before we had, even here when the ISM in 2003 went up, it took a while for the market to do the same, but it went up as well. So for this one to go that far away from another, normally is not a good sign. And the chances is that the stock markets could really be hurt more to the downside. Why do I think that might be happening? Well, because I think that this is a bigger thing happening here. Wilbur Ross said that the U.S. won't hold back on tariffs if the Chinese drag their feet. So we might we might be seeing new tariffs actually put in place December 15th by Donald Trump. And those tariffs will not only tariff all Chinese products that are left, and those also include all these products that people use on an everyday basis, cheap stuff, that's actually good to have. And it will add tariffs to existing products. So that can really become a very, 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 very tough situation. And we can see that Donald Trump yesterday also did something that can be seen as showing he's not playing around. Because yesterday he increased the tariffs back on steel and aluminum from Brazil and Argentina. And what he was saying is that Brazil and Argentina have been presiding over a massive devaluation of their currencies, which is not good for our farmers, poor farmers in the U.S. Therefore, effective immediately, I will restore the tariffs on all steel and aluminum that is shipped into the U.S. from those countries. What's happening here is that Brazil made a deal with China. Argentina, poor guys, they're already economically dying, and their currency is losing and losing and losing. And that's why people post pictures like this, like farmers grow steel and aluminum. They don't get the how it's related, because it's related just simply by Brazil making a deal with China over agricultural products. And because Brazil is being accused to devaluate its currency so it can make its product cheaper on the global market, that is what Donald Trump didn't like, and why he's stepping in here. And then he says, look, guys, I'm not playing. I understand your games. And then he also made another more or less demand to the Fed. The Federal Reserve should likewise act so that countries, of which there are many, no longer take advantage of our strong dollar by further devaluing their currencies. This makes it very hard for our manufacturers and farmers to fairly export their goods. Lower rates and loosen Fed. This is what he is demanding from the Fed. And what we see really right away happening is the dollar going down. So the dollar saying, there's a presidential order for the central bank to do something to devaluate our currency. Boom, let's buy into this rumor, or more or less sell the dollar into the rumor. And that's really what's been happening right now. And that could actually persist because the situation remains in place and all the moving parts are still moving in that direction. By the way, that's also interesting here. Donald Trump saying that the U.S. markets are up as much as 21% since the announcement of tariffs on the 3rd of January 2018. Sorry, the U.S. is the other way around, so 1st of March. And the U.S. is taking in massive amounts of money and giving some to our farmers who have been targeted by China. So, long story short, Donald Trump is ready to really play hardball. And China, on the other hand, it looks like they are also very much ready to do so because Hu Jin is tweeting that based on what I know, since Congress plans to pass the Xinjiang related bill, because that's another meddling by the US into other countries' affairs, whether you think for good or for bad politically or for good reasons or not, I'm not having that kind of discussion here because I don't want this to become a political forum. But what I'm saying is that there is a country, the US, that it gets involved into other countries' affairs in a way that they want to make the rules for the other countries. Whether that's good or right or not, I don't know. But that offends people of those countries, obviously. And so what Hu Jin is saying, China is considering to impose visa restrictions on U.S. officials and lawmakers who've had odious performance on the Xinjiang issue and might also ban all U.S. diplomatic passport holders from entering Xinjiang. So what it means is that China is seeing its economy not going down the drain any longer so badly. The US is starting to feel the negative side of that trade war more and more and more, while the US is actually trying to even politically now, put China on the spot. And the Chinese are saying, like, wait a minute, like, you, first of all, you have no business with our affairs. Secondly, our economy is starting to do better again. Yours is starting to show weaknesses. Like, do you really think that you are the ones dictating this deal's terms? And this is why I'm making this so long for you to follow, is that we are very likely looking at more confrontation between US and China. And that could really be the cue for us to expect markets, stock markets, to go further down. And that's really something to absolutely consider here. It is an absolute possibility, and possibly also one that I think is quite probable at the current stage. Now, coming away from that geopolitical side of the markets, let's have a look at currencies. So, for example, we have the Australian dollar. That was very much troubled by the expectation of a QE. Now, what happened? You can see that for those who took the risk, the price really moved well to the upside. And the RBA did not change the interest rate. It kept it at 0.75%. But the most important part was saying that they, given these effects of lower interest rates and the long and variable lags in the transmission of monetary policy, the board decided to hold the cash rate steady at this meeting while it continues to monitor developments, including the labor market. So what it shows is that the bank is no longer going to proactively do something. So they're not going to just cut rates or do QE just before something happens. They said, okay, what we did so far is enough, and we're going to keep it here and wait for the lag, for the delayed effect to show, to play out. And that's why the Australian dollar could see some further upside, especially since also we had news out of the US where the Fed were saying they are prepared to let their inflation target overshoot. So all in all, we see that the dollar's possibly positioned for further declines, while other currencies, and especially Australia, pulled up by the good Chinese data, could see some further upside. Now that we climbed to 68, we could be even testing the 68.50, 68.60 up here. That's that resistance area that is quite relevant for the next stop of that currency here. Elsewhere, we see the Kiwi. The Kiwi is actually very much the overperformer because we are, where are we? Well, even against the euro, you can see the euro that gained against the dollar still lost against the Kiwi. So the Kiwi is really showing strength here. And the good thing about the Kiwi is that there is a the finance minister there said that there is a preparation of a significant fiscal package. So we talked about that possibility of fiscal package yesterday, if you remember. And and that is actually playing out now in the market. So what he said is that we are currently finalizing the specific projects that the package will fund, and we can't be getting more details now, but it will be significant, is what he says. So the Kiwi now that has been troubled by weakness so heavily could find its way back into the trading range between the 65 and the 67 even up here. So that is a trading range. We'll probably need to wait now for the price to dip again, to come back down, and we will see if it holds above that 64.80 level. If it does, then the chances for a renewed leg to the upside are increased, and that is the one I would like to then catch as well, because just getting in right now to me is a little bit strategically not the best. You want to go in on a retracement on the way up. So yes, sure, here on the 30-minute there was not much of a retracement to catch that kind of move, but the retracement was earlier here. That is what is called an accumulation phase, and it was quite clear that the Kiwi had good chances, and it showed these chances to be true. These things don't always work out, obviously, but they do work out, and that's why we discuss these things that we actually discuss here, in order to make us aware of these opportunities in the market that obviously have risks to them associated as well. So don't get me wrong, but that's why we try to decipher that, Games of Thrones, for the lack of a better word. So, looking at other markets, like, for example, the commodities. What we saw was like a massive drop in oil the day before, if you remember, for China and even Saudi Arabia, not China, for Russia and Saudi Arabia, saying that they're not sure if they want and can commit to further production cuts. And on a daily basis, oil remained very much low. So even though we have that trend here that looks to be holding just now, there is a chance, especially if the trade war heats back up between the US and China, and everything is pointing towards that right now, that oil could see further downside. Also, always watch the oil stocks that will come in. For example, we have some tomorrow here on Wednesday that really have a big chance to move the oil price. Looking at the calendar today, just so you get an idea, after we had the RBA statement, which we just discussed, there's not all too much going on here. We have the Brazil GDP, all right, producer prices out of Europe. Nothing that is really in the first row of important things, but we can look at the business conditions, New York business conditions index here in the afternoon, just to see if there is going to be another batch of negative data out of the US. Look, if these ones come in strong, then maybe yesterday was what can be called a one-off. So we'll see what's going to happen there. But all in all, negative data out of the US could really put markets in more distress, because the markets are I think they have a good they have a good reason to be a little bit afraid now, because if these tariffs come on December 15th, and that is, remember what I talked about, I think last week or so, that the strategy of the US administration has been, when the US markets were doing well, they've actually increased the pressure on China, because they said, okay, whatever happens now, if the markets drop, they were so high, they're going to drop to still high levels, and so we can increase our pressure towards what we want to achieve with China. And I think that it looks like we're in for another round of the trade war cycle, and that could become something interesting for gold. Right now, gold is not really taking advantage of all of this. It's more or less doing nothing. Yesterday moved like a couple dollars, but you can say we're very much here still. But again, if that situation between US and China goes the wrong turn once again, and it looks like it really might again this time, so one more time, then gold could have a good chance to see upside again, back to the 1470 and the 1480. In fact, that could be the next target here for the yellow shiny metal. Elsewhere, what we see, and let's have a look at some other major currencies for a change. The euro dollar, from a technical standpoint, we went up, and it was like one of the biggest moves up in a few months, I think September. But all in all, and that's why I encourage you to keep looking at the daily time frame at all times. Why? Because the daily gives you a lot less noise in terms of what's really happening. So what's happening is that, okay, we did a huge recovery, but we did not break significant levels, which would be at 111. So we'll have to see, does the euro have some juice to target the 111 and go up, that would be from a technical standpoint important. But what you can see is that the present level we're at right now was just the level also here between September and October, when we then dropped even lower. So we're not out of the woods here by any means. Especially Europe has a lot of own issues. And yeah, yesterday, okay, economic data came in better out of Europe, so they have a little bit of a momentum building up here, but that momentum can only really reach something significant if it breaks the 111, which has been very, very tough to break, to say the least, in the recent weeks. So, and you can see that we bounced off that 111 quite heavily right away. Even in that huge move, we didn't even reach the 111 per se, like about 10 pips or something. We didn't. Even on the second attempt, we didn't. So, okay, then overnight came, so now could be another chance. And really, if we see a break above the 110.80 here on the 30-minute, then we could retest the 111. And all in all, again, like I said, that's the most important area for the market that needs to break to the upside in order to show really strength here. Yeah. Apart from that, yeah, okay, the pound saw a little bit of downside yesterday, not really attributed to anything, but also the move wasn't really big also to begin with either. But you can see that also on the daily here, we're still very, very close to that 130, and that's a little bit like the 111 in the euro dollar. The pound, I think, is a lot more reliant on new polls for the upcoming election, which will hold markets captivated very surely starting from next week at the very least. And in between then, it's just important not to drop below the 28. And if we see a break above the 130 for further dollar weakness, which could also be happening. Remember, I mean, Donald Trump is doing everything to try to achieve that. But if the struggle between China and US becomes more intensified again, then it's probably the dollar is going to go up again. So that could be the turnaround moment for the US dollar. So let's wait and see for these new news to trickle in over the course of the day. And looking at in the land of crypto, for example, what we see is that Bitcoin more or less did nothing. Yesterday we like 7.2, 7.2, 7.2. We were rejected from the 7.2 repeatedly, but we also did not make any headway from there. So it remains very much what can you say? I wouldn't even call it neutral. I would still say there is a little bit of a negative bias here, especially in the bigger time frame. Because in the bigger time frame, we continue to see rather a descending lower lows, lower highs kind of movement here. And that 8,000 is something that we just don't seem to be able to reach and hold. Not even the 7.4 right now, which remains that area here, this area here. Is the important one, that we get above the 7.4, 7.5 in order to retest that 7.6 and up to 7.8, which was right over the weekend. So right now it still looks like it's barely holding, and you see there's many attempts to the downside here. The volume is also getting lower as we speak, so we could see the Bitcoin really struggle with the 7.2 and essentially go lower. On the other hand, 7.4, if we get above it, then there is a good chance. And right now we're right in the middle at 7,318. But again, we were coming from a lot lower, 7,260. So the somewhat negative bearish bias remains in place here from my perspective, at least. So that's my overview of the market this morning. As always, thank you very much for listening in. I wish you a great, successful trading day. And if you like what we do here, leave us a comment, leave us a critic, share us, and subscribe to our channel. We'd be very, very happy to have a conversation and any type of communication going on here. All right, guys, then have a great day and see you tomorrow. Bye-bye.